What's up everyone, it's Caddy with Money Investing. In this video, I wanted to go over 10 questions the market absolutely needs answers for from Jerome Powell on Wednesday, March 22nd, when the FOMC meeting takes place, in order to gather some certainty with respect to where we're headed amid all this uncertainty and all this chaos that's happening around us. So I hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. I've kind of made the list. And if I forget anything, if I don't put anything on the list, let me know in the comment section down below. I think it's going to really help us all out to really have an idea, have a guideline or a framework to work with when we are going into this meeting on Wednesday, which is supposedly going to be the most uncertain meeting since 2008. So I actually did a video 1 year ago, so exactly 1 year ago, going back as far as February of 2022, talking about the Federal Reserve and Jerome Powell being in a rock and a hard place. So this is a video that I did 1 year ago. Not a lot of people watched it, but I talked about this exact scenario where Jerome Powell is going to be in a place where he's going to be in between a rock and a hard place. And that place is that whatever he does is going to be a very, very difficult thing, right? So in my opinion right now, if he doesn't raise rates, right, if he starts to pause or starts to be a bit more dovish in this meeting, number one, he starts to lose credibility. Number two, we give up on that inflation fight. That's pretty much the messaging the market and investors in the world is going to get if Jerome Powell doesn't do anything, right? If he pauses and starts cutting rates and switches on his pretty much policy path, that's going to be a big red flag for the market. However, if he continues to raise rates, there is going to be even more trouble ahead with respect to what we have seen with banking crisis, more bank failures, and more dominoes to fall over with the economy weakening, consumer spending dropping, and unemployment potentially spiking. That's what we talked about. Jerome Powell, unfortunately, as difficult of a situation this is in the middle of a rock and a hard place. Now, I already mentioned the dual mandate chart. This is the dual mandate bullseye chart as mentioned in one of my other videos. And of course, ideally, the Federal Reserve wants to be very low on inflation and very low on unemployment. Target rates are around 2% inflation and 4% unemployment. Unfortunately, we are well above 6% for essentially headline CPI, and core we're sitting a little bit over 4%. And ideally, I mean, the bullseye really for the Federal Reserve is over here. I mean, they would prefer to come down here so that they can keep inflation down and unemployment lower, but we're all the way over here. And it doesn't necessarily mean unemployment over here. I know it says unemployment, but unemployment is a significant lagging indicator. So we're already starting to see significant signs with respect to the banking crisis and a lot of other leading indicators, construction spending, home sales, the list goes on and on, consumer sentiment, PMI manufacturing index, right? There's a lot of signals out there already that are suggesting some cracks in the economy to begin with. So the last place that we really want to be, like I said in my previous video, is going to be all the way over here. This is not where we want to be. It's going to be a situation where it is going to be far catastrophic for the Federal Reserve or the Treasury Department to handle, because in that scenario, we are in a full-blown recession with high levels of unemployment and high inflation as well. That is not a place that's going to be worth it, right? That's not what we even want to talk about. So in my opinion, there's a lot of questions that the Fed needs to answer. So I've kind of made the list here, 10 questions that I believe we need the answers to from Jerome Powell and the Federal Reserve. Some of them are obviously going to be the most self-explanatory, the most straightforward questions, right? Rate hikes and what's the policy path. But we're going to make a list. So this might not be 10 questions by Wednesday. This might be 20 or 30 questions. I mean, some of the things that I'm looking for really. So let me know in the comment section down below. Pause this video, comment what is going to be your question. What do you need answers for from Jerome Powell? So we can have at least a good list and a guideline, and we can kind of check those boxes as we're listening to Jerome Powell on Wednesday to have a good understanding on, okay, was this covered? Was this not covered? Did we get any details on that? So that's going to be the goal. So again, pause this video, comment your question. What do you think Jerome Powell needs to address in his upcoming press conference? So first question is going to be the rate hike, right? So obviously, how much are we raising rates by? Are we pausing? Are we cutting? Are we raising rates? That's going to be included in the statement that comes out at 2 p.m. Eastern. The second thing is going to be the rate guidance, right? So this time, they're also going to be releasing their SEP. That's a summary of economic projections. So they are going to be telling us, what their forecast is for the next 3 years and then longer run as well. And they're also going to be releasing the dot plot, which is going to be from all the members of the FOMC. and where they see rates, what the expectations are for interest rates moving forward. So two really important things: the rate hike itself, are we getting one? Are we getting a pause, cut? What are we getting? And the rate guidance for the future, the policy path for the future. The third thing is going to be inflation expectations. Now that is again going to be in the SEP, the Summary of Economic Projections, but also in the speech from Jerome Powell, because this is going to be the first FOMC meeting after 2 inflation prints. The last meeting was in the early February, right? So they didn't actually cover the February inflation numbers. If you guys remember, inflation numbers on February came out on Valentine's Day, February 14th, and the meeting was in the first week of February. In fact, I think it was February 1st and 2nd, towards the end of January, January 31st and February 1st, might have been those 2 days, but they didn't cover inflation back then. They didn't cover the March inflation. So 2 inflation reports we've already received. What is going to be the expectations moving forward? How is the Federal Reserve kind of really extrapolating some of the data that's been coming in? Number 4 is going to be with respect to employment. So that's another thing they are going to release. Do they still expect the labor market to be very tight? Vacancies have been coming down. We got the JOLTS report. We know unemployment rate ticked higher, 0.2% from 3.4 to 3.6%. Any type of color, any type of addressment on around that topic, very, very important for Jerome Powell and, of course, for the market. Number 5 is obviously what's going on with everything around, Signature Bank and First Republic, and we got Silicon Valley Bank, and now we've got Credit Suisse and UBS. I mean, it's a complete chaos, right? How are they planning to contain the banking crisis? And it's going to be very much about quantitative easing and injecting the money supply, which is where we're going to get to here in just a minute. But any sort of Jerome Powell needs to address this, obviously, because he controls monetary policy, and this is a pretty big deal for the entire U.S. banking sector and, of course, the economy as well. Number 6, the new program that they are launching. I want to know more about it. So that's going to be the Bank Term Funding Program, or the BTFP program. What are the terms? What are the durations? How much in quantities? How many banks are going to be borrowing? Like, what can we expect from this program moving forward? I think they've already lent out close to 11 or 12 billion dollars from their BTFP program, and the other ones were just regular discount window loans of about 140 something billion dollars. So again, this is a new program. I want to know more about what this is going to do to the money supply moving forward. Another thing that I think is going to be very important, someone's got to bring it up, is going to be why face value? Like, why is the Federal Reserve accepting all the bank's collateral at face value? Or why is it not accepting at face value? Excuse me. I gotta say it again. Why is it not accepting at face value? It's accepting at market value, which is substantially lower than where the face value was, right? So, for example, a bond that the bank would have bought at $1,000 face value, since interest rates have gone up, the market value could be $600, $500. They've already dropped like 40-50%, and the Federal Reserve is basically just getting 40 to 50 cents or 60 cents on the dollar, and they're giving these banks a full dollar. They're pretty much giving them at face value. They're lending the money out at face value. So that's a huge question. Why is the Federal Reserve financing their losses? That's the real question. Why are they taking on these collateral at market value and giving them the full face value? That just does not make any sense. And I want to know why they're actually doing it. Is it just simply to help these banks out? Because, if they keep doing this, there's like literally no downside. Like, everybody should be a banker in that scenario, because you've got unlimited upside with literally no downside. Every time you've got losses, the Federal Reserve is there, the Treasury Department is there to kind of backstop you. So very, very important question. Number 8, USD swap lines. So we learned about it yesterday. There was a joint statement between the Treasury, the Central Bank of the US, the Federal Reserve, and central banks over in Bank of England, Bank of Japan, Bank of Canada, and the ECB, the European Central Bank. And they are opening up their swap lines to kind of increase their frequency and provide US dollar liquidity to all these central banks around the world, which can then, of course, provide more liquidity to their banks in their home countries. So again, what are the terms, durations, quantities? More information on that. Super important for the market, because that's really what's going to cause a lot of increase in money supply moving forward. The Fed's balance sheet, right? It swelled a little bit, 240 something, actually 297, close to $300 billion in loans that they pretty much gave out to all these banks, and that increased their balance sheet here in terms of total assets. So what does that mean? Are we kind of pausing here, going back to QE? What's the deal? That's going to be question number 9. And what can we expect moving forward in terms of the balance sheet roll-off with respect to mortgage-backed securities and U.S. Treasuries as well? And last but not least, overall tone from Jerome Powell. Is it more dovish, hawkish, neutral? What can we pretty much assess from what he's talking about. So hopefully you guys got a good understanding. This is, again, a good guideline and a framework on what I'm looking for going into this meeting. If I miss anything, comment down below and we can add it to the list. And yeah, hope you guys enjoyed this video, and we are ready for Wednesday, March 22nd. Super important day. And make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining us. So always happy investing. I'll see you all in the next video.